Okay, well, welcome to our webinar. This is all about what you need to know about tax in 2022. So delighted to be joined by Simone Smith, who's our tax manager here at Rotherham Taylor, who's going to take us through this presentation. We are recording this webinar, so we'll make it available as an on-demand version on the website tomorrow. And for those of you who've registered or are attending live today, we'll make sure that you get a copy of that emailed to you. The webinar is scheduled to run for about 45 minutes, dependent on how many questions we get. If you would like to ask any questions throughout the presentation, please just use the Q&A tool, which is on your toolbar. We will be able to see those and hopefully we'll get to answer as many of those live before the end of the presentation. So I'll come back at the end and hand over to Simone to kick it all off from here.
Thanks, Jo. Hi, everyone. Welcome to today's webinar. I'm going to be talking about tax in 2022, what you need to know. So I'll cover key end of year tax planning that is specifically for the tax year that's about to finish, but we'll also talk about some general tax planning as well. If you do have any questions, excuse me, if you can put them in the Q&A or the chat box, and as Jo said, we'll come to those at the end and answer as many as we can. So I'll just explain to you who we are first. So we are Rotherham Taylor Chartered Accountants. We are a general accountancy practice based in Preston in the northwest of England. But we do believe that our clients deserve an accountancy and advisory solution that works best for them. So we do tailor our services to the specific needs of our clients. We are predominantly a firm of chartered accountants, but we do also have tax advisors, so we can provide the bespoke service that you need, perhaps for your business or your personal tax affairs. So we will talk about the substantial changes in taxation that we foresee in the upcoming year and perhaps what's changed in the year that we're in at the moment. There are going to be significant changes that we'll cover in more detail as we go through the webinar. But the main changes that we'll chat about are the increase to the corporation tax rate that will affect some companies, not all of them, but it will see the reintroduction of the marginal relief calculations, which we were all happy to forget about, to be honest. Higher dividend tax rates are being introduced from the 6th of April 2022, so that is very topical right now. New capital allowances have already been introduced, like the super deduction. So we'll talk about the rates that are available for that and what sort of expenditure would be covered. As we've already seen, there's been a freeze on personal allowances and reliefs. That is already in place and will be in place for the next few years. And making tax digital is being expanded. The next expansion to that is in April 2022. But we'll also touch on when it's going to be expanded further after that date. So if we have a look at a quick guide to year-end tax planning, the clock is ticking. We are in February at the moment and the tax year ends on the 5th of April. But not all of the things that you need to consider and do to utilise the tax reliefs and allowances available to you are quick. For example, if you want to make additional pension contributions, that money needs to be with your pension provider by the 5th of April, rather than it just leaving your bank account. So you do need to leave yourself time to utilise all these allowances that you might not have claimed. But there are lots of steps you can take to reduce your potential tax bill. As I said, you do need to do careful planning that can take time. So now is the time to act while we've still got a month or so before the tax year ends. We'll start with business tax planning. So businesses and their owners need to consider what your current position is before the tax year ends. Now, it's worth noting that for a lot of businesses, their company or their business accounting year doesn't always coincide with the income tax year. So it's time now to think about these to make sure you're utilising all the allowances that are in line with the tax year. But it's also a good idea to consider these again before the end of your accounting year as well. So dividend taxation Have you used the full 0% dividend tax band, which is currently £2,000? It is £2,000 for the next tax year, but that's not to say that it won't change or reduce in future. It was £5,000 a couple of years ago, so there is scope for it being changed in future. Another thing to consider is that the rate of tax for dividends increases by 1.25% from the 6th of April this year. So it is important to make sure that you've used not only your 0% dividend tax band, but also your basic rate tax band. It may be worth paying more tax than you normally would this year at a lower rate compared to having the same amount of dividends next year at the slightly higher rate. Corporation tax, so this is the tax for companies. Have you made use of all of the reliefs and allowances that are available to your company? From April 2023, the rate of corporation tax is going to increase to 25% for companies that have got profits over £250,000. That is quite a steep jump from the current rate of 19%. However, it's not just going to be the case that it's either 19% or 25% tax that your company pays. As I said, they are going to reintroduce what's known as marginal rate relief, which means that if you have profits between £50,000, which is now going to be known as the small company's profit rate, and £250,000, which is the 25% tax rate, then you will pay corporation tax at a percentage somewhere in between 19 and 25%. It is quite a complex calculation, but generally speaking, it's just a percentage increase between those two figures will determine what your effective rate of tax is. Carrying on with business tax planning, capital allowances. The annual investment allowance is at £1 million at the moment, and it will remain at that level until March 2023. So incorporated companies should consider whether it's time to buy plant and machinery now while the annual investment allowance is at that high level. The other benefit of incurring expenditure now on plant and machinery is that the new super deduction has been introduced. I love that name, by the way. Whoever came up with that is an absolute genius in my eyes. But that will offer you corporation tax relief of up to 130%, which seems crazy because why would you then not want to buy the equipment if you're going to get a tax relief for more money than you've actually spent? Also, research and development tax credits. Not many businesses seem to know about these or think that they would be eligible for them. But more businesses are eligible than you think. Last year, businesses claimed more than 7.4 billion of relief, which is a huge amount, and the government are really behind research and development in the UK. So it's time to consider whether you have any eligible projects. There's no harm in asking whether it's something you can claim for. And we do have links to advisors who can look into what your business does and let you know whether you would be able to make a claim for research and development tax credits. Your company also doesn't need to be making a profit to claim these tax credits. You can be making a loss and you can give up the loss to get tax back, even though you've not paid any tax in the first place. So it is definitely something worth looking into if you've got any new projects underway. Capital gains tax does also apply to businesses. But businesses don't have the annual exemption. So what you would also need to consider is if you have, as a person, used your annual exemption for the current tax year, it's still £12,300, and that's going to carry on into future years. It is being described as a freeze on personal allowances, but I suppose in reality it is more like a tax increase because the allowances would normally rise each year. So it is important to make sure that you're using them. Good tax planning in terms of capital gains tax in your business could include gifting assets. such as shares in a company if you're an owner manager over a period of time to ensure that you utilise multiple years worth of your capital gains tax annual exemption. That is quite a good planning point for family businesses where you are looking to perhaps bring your children into the business. And it's also quite good as it links with inheritance tax planning. In terms of your business, if you are planning to sell, business asset disposal relief, which was formerly known as entrepreneurs relief, the lifetime limit on that has been reduced in recent years. So instead of £10 million now qualifying for the 10% tax rate, only £1 million qualifies. For many small owner-managed businesses, this might not have that much of an impact. But if you do have a company that's worth more than £1 million, this is where the capital gains tax multiple year exemptions can help, because perhaps on the sale of your business, it wouldn't all be covered by business asset disposal relief. If it isn't, then it is likely that your tax rate is going to be the higher capital gains tax rate of 20%. So there is a 10% tax saving to be had. There are specific rules that you need to meet to be able to qualify for business asset disposal relief. So again, this is another one of those areas where you do need time to plan and speak to your advisor to make sure that you are meeting the qualifying conditions, because a lot of them have a time limit linked to them as well. Other business tax planning tips: there are a wide variety of ways for businesses to reduce their annual tax bill. But a lot of businesses aren't in the position of thinking about this in terms of a sale. You do want to support the goals of your business, such as employee recruitment and retention. So there are ways that you can keep your staff motivated and bring new staff on board whilst also being tax efficient and giving them a reason to stay within your business. We'll run through a few of these. So salaries, these are specifically to do with really owner managers. Have you considered paying a salary at a tax efficient level? In terms of owner managers, that's directors who are also shareholders. You don't necessarily need to pay a large salary. You could set a salary at the national insurance lower earnings level, which means the director would obtain a qualifying year for state pension purposes, but they also wouldn't have to pay any national insurance on that salary, and more than likely wouldn't have to pay any income tax on that salary. And then that person's income will be topped up by dividends. Benefits, this is one of my favourites because there are a wide range of benefits and also salary sacrifice schemes that are available to both employees and directors. We did recently run another webinar on tax efficient benefits and expenses, which I highly recommend you go and have a watch of. My personal favourite are trivial benefits, which is where you can give your employees or directors non-cash rewards, which in most cases is a voucher or an actual item, up to the value of £50. And as long as that voucher or item is not in return for services, so it's not for a job well done, it's perhaps happy birthday, here's a gift, then it is excuse me, is tax deductible for the business, but it's also tax exempt for the employee. So that's a really good thing to do. Or perhaps things like Christmas turkeys or Easter eggs, annual staff events. Those are all really good examples of tax exempt benefits that would also support your business and its employees. Other things that you could do, enterprise management investment, which is the EMI share scheme. That's a tax efficient way of giving shares to key staff to help retain them. And it also provides them with a sense of ownership and gives them the boost to work hard to ensure your business grows and does well. What would normally happen in these schemes is you would give the employees an option to buy shares. So you would say something like, in 5 years' time, we will let you buy shares at what they are worth today. even though in 5 years' time you would hope that the shares would be worth more. So that encourages your employees to grow the business because they would be able to buy the shares at a much lower value than what they would be worth on the open market. Expenses, so these do link in with benefits, but have you made sure that both you, your employees and your team have claimed for all of the eligible expenses for this year? Things like travel, perhaps, if you don't pay mileage at the approved HMRC rates, professional subscriptions, any work equipment that anyone's had to buy due to working from home because of COVID. So these expenses, either you could pay for them and your business would get tax relief, or perhaps if you're not reimbursing your employee the full amount like the mileage, they can claim the tax relief separately from HMRC. And finally, profit extraction. Are you making the best use of the opportunities through dividends and directors' loans to extract profits from your business? So as I mentioned on the salary points, an owner-manager would normally take quite a low salary from the business and then top that up through dividends. There are other ways for you to extract profit from your company. So for example, if you've already taken quite a significant amount of dividends and you perhaps don't want to take more so that you're paying additional tax, and maybe you need a small amount of cash just for a short amount of time, you could take a tax-free director's loan from your company up to the value of £10,000. There's no interest to pay on that as long as the balance does stay below £10,000 within the tax year. However, it does need to be repaid within 9 months of your company year end. Otherwise, the corporation tax surcharge would be due to HMRC. Other ways to extract profit from your business, maybe if you've loaned your business money, either to get it through a period of difficult cash flow or because you're just starting out, the business could pay you interest on that loan. And if you're a basic rate taxpayer, you can receive £1,000 worth of interest each year tax-free, which will be covered by your personal savings allowance. If you're a higher rate taxpayer, that would be £500, or if you're an additional rate taxpayer, you actually wouldn't be entitled to a personal savings allowance. Another good way to extract profit from specifically a company business is pension contributions. So perhaps you don't actually need the cash now, but there is cash in your business that you don't want to be sat in there for a long period of time. You could pay that into your pension pot. That would be a tax deductible expense for your company, as long as it's part of a reasonable overall salary package. And you wouldn't personally pay the tax on that money until you came to draw the money from your pension. So that can be another good way to extract profit from the business. We'll move on next to personal tax planning. So we'll run through some key points of how you can reduce your tax bill. One of the big ones for either couples that are married or in a civil partnership is inter-spouse transfers, because transfers between spouses are generally exempt from capital gains tax. So it's a good way to move specifically capital assets around so that the income will follow those. So if you have one partner that is paying substantially more tax than the other, doing this could mean that you move enough income to utilise the other partner's personal annual allowance or their basic rate tax band. So you can have some quite good tax savings from this. The best time to do it is if one person has an annual income of between £100,000 and £125,140. Now that does seem like quite a random figure, but once your income exceeds £100,000, you start to lose your annual tax-free allowance, and you lose that for every £2 that your income exceeds £100,000, you lose £1 of your tax-free allowance. So if the tax-free allowance is £12,570, you would fully lose it once your total income is £125,140. So that's where that figure comes from. And between those two income amounts, your effective tax rate is actually 60%, because you are still paying tax at 40% on any income that you earn, but you're also losing your 20% tax-free allowance. So that income that was previously covered by your tax-free allowance is now taxed at 20%. So that's how you get the 60% effective tax rate. So if your income is above 100, you do want to be either trying to reduce that by perhaps pension contributions, gift aid, charity donations, or you want to be trying to move the income to your spouse by moving the capital assets that they're attached to. So say if you have quite a substantial shareholding portfolio, you might want to utilise the inter-spouse capital gains transfer to move the shareholding, which would then move the dividends to your spouse. You could also exchange your salary for benefits. So as I mentioned, if your income goes above £100,000 and you want to try and reduce the amount of income that you have, you could ask your employer, or if you are the employee, you could just do this and perhaps give up part of your salary for payments into your pension or into a share scheme. There are multiple types of share schemes, so you could have a look at what's available and what your employer is willing to support. And if those bring you below the £100,000 threshold, then it would avoid you having to pay the 60% rate of tax. Dividends and bonuses. So I touched on this slightly when we were talking about the increase in the dividend tax rate. You might want to consider paying these early so that they fall into the current tax year rather than the new tax year. This will require some quite careful calculations. Obviously, we're not saying that the dividends will be tax-free, but the tax should be lower. Really, it depends on what level of dividends you were planning to take last year, what you've already taken this year. But now is the time to do these calculations so that you do have the time to make any additional payments or make these declarations in your company records. Equally, if individuals have relatively low levels of dividend tax income, you may choose to defer dividends and take them in the new tax year instead. Perhaps if you were planning to take another dividend before the end of this tax year, but you had no plans to take one next year, you might want to defer to ensure that you're using your dividend tax-free allowance or any personal tax allowance that you might not have offset against your salary, for example. Directors' loans, as I said, the tax-free interest amount on loans, you could have up to £1,000 of interest tax-free. You can't pay interest at any rate you choose just to make sure you meet the £1,000. It generally does need to be a commercial rate, say 6 to 8% is what we're seeing at the moment. But if you were to have a look at what interest rate perhaps you would pay on a third-party loan for an amount similar to what you've loaned to your company, that would give you a good idea. But HMRC do generally accept around the 6 to 8% mark. And then finally, stamp duty. We are back to the normal rates now, but as we've all seen, they have changed and there's been holidays introduced and lower rates for periods of time. So that's not to say that they won't change again. They may go up or they may go down. But something to consider is that if you're looking to purchase a home or a second home, then you may be liable to the 3% surcharge, which is on top of the current rates of stamp duty. So even if there is a stamp duty holiday, the surcharge still applies. So if the normal rate is 0%, the surcharge rate would be 3%. Just something to consider, especially if you're looking to purchase a second home, because if you do own two homes at the end of the day, the surcharge would apply. So you would need to consider whether you're buying the second property at a good time or whether you should wait to see if you can sell your own home first. Just things to consider and maybe chat about with your advisor before you make any decisions. Inheritance tax planning. This isn't something that many people think about in terms of end of year tax planning. For inheritance tax, many people think it's too early for me to think about that now. I've got a lot of time left to live. It's morbid, I don't want to think about it. But in terms of inheritance tax, time really is the best thing that you can give yourself in terms of the planning. You need to make sure that you've got plans in place for the future, especially because inheritance tax rates, although they've been stagnant for a while, there are rumblings that things are going to change. So it's best to make sure that you do have plans, especially because a lot of the current rules centre around the 7-year rule, which means if you were to give something away, you would have to survive for 7 years before it was to fall out of your estate for inheritance tax purposes. So we'll touch on a few key points. So generally speaking, in terms of your estate as a whole, charitable giving is something that you should consider. If you leave at least 10% of your net estate, so that's after your liabilities have been paid, if you leave 10% to charity, you may be eligible for a reduced rate of 36% of inheritance tax rather than 40%. So this can save your family money. It's definitely worth considering. You can have clauses written into your will that don't specify a particular amount to make sure that you do leave at least 10% to charity. The big one, which is the point that I hope most people take away when I mention inheritance tax planning, is that you can give away a total of £3,000 worth of gifts each tax year without them being added to the value of your estate. So the 7-year rule wouldn't apply in this situation. You can give up to £3,000 away and it's just gone then. You don't need to think about it again. But the allowance can only be carried forward over 2 years, which means it won't last forever. So if you don't use it this year, you can carry it forward. But now's the time to consider whether you've used the allowances for the last 2 years, which might enable you to make a larger gift this year. As it says on the slide, you can make larger gifts above the £3,000 allowance, but these will be affected by the 7-year rule. What the 7-year rule means is that for every year that you live past you making the gift, the effective rate of inheritance tax decreases. So the longer you survive, the lower the amount of inheritance tax that would be due. But you have to survive for 7 years after making the gift for no inheritance tax to be due at all. There are other types of gifts that you can make. So you can make what's known as regular gifts out of income, and these are always tax-free. So again, these aren't covered by the 7-year rule. They need to be made out of income, not out of capital. So it's extra money that you've got above and beyond what you need to support your normal standard of living. And some good examples are perhaps paying for your grandchildren's school fees. We do have a client who pays his granddaughter regular gifts out of income because she supports him to enable him to stay at home. It's just important that they are documented, so perhaps writing a letter to the person you're going to make these gifts to. Dear grandchild, I'm going to pay your school fees out of excess income that I have on an annual basis. Passing on your pension. I don't think people really appreciate how important it is to make sure that your will is set up properly, specifically with regards to your pension. Because in a lot of cases, if you leave your pension specifically to somebody in your will, then it does have tax benefits. And finally, trusts. Now, trusts are very complicated. There are ways that you can make a trust to protect your assets, minimise tax liabilities, and save tax, but there have been a large number of changes to the treatment of trusts, and in many cases the income tax treatment during lifetime is actually higher than if you were to hold those funds yourself. So it can be complex, but they can be beneficial in some circumstances. So if a trust is something that you'd like to consider, really, please do seek advice from your tax advisor. So we'll move on to pensions next. Nobody wants the pensions to be taxed by the taxman. It is lovely that you can take out a quarter of them tax-free and the rest will be at your marginal tax rate. But along with inheritance tax planning, pensions is something you should consider during your lifetime rather than just when you plan to cash them in later on in life. If you've got substantial amounts in your pension, or you're expecting to put substantial amounts in, it's worth considering protecting your pension. The lifetime allowance has decreased substantially in recent years. It currently stands at just over £1 million, but that's not to say that it won't change. So you may want to consider protecting your lifetime allowance if you're getting close to the current lifetime allowance. What would happen then is if it was to reduce, you would be protected at the current limit. And also your annual pension allowance. So you can invest up to £40,000 a year into your pension tax-free. There are caps for what you can personally put in up to the value of your salary, but you can invest up to £40,000 a year. And you can carry that unused allowance forward up to 3 years. So perhaps if you are a high earner, you've had a pension pot over the last couple of years but not put anything into it, you could potentially put up to £120,000 into your pension in one tax year. So it's definitely something to consider before the end of the year, because once we flip over into the new tax year, you could have potentially lost the earliest year's allowance that you haven't used. As I said, there are caps on pensions. Normally you can only put in up to the value of your salary, but all UK residents, including children, can make annual net contributions of £2,880, and the government will top that up. So what would happen is £3,600 would actually end up going into your pension, and you can do that regardless of whether you have any earnings. Now, this can be really good, perhaps if you've got excess cash, you've utilised all of your tax allowances and savings, and perhaps you want to put some money into your children's pensions for when they're older. If you were to start quite young and you were to put the £2,880 in a year and it was to grow, then I've seen examples where on retirement at 68, 69, the children could have up to £1 million in their pension pots. So something to consider if you've got excess cash. And then finally, when you draw down your pension, once you reach 55, you can normally take out the pension. So you could take out 25% tax-free, or you could take it all out and the remainder would be taxed at your marginal rate. So what you would want to do around pension drawdown time is look at what your earnings are for the year. So perhaps if you were 55 now in February, but you've been working for the full tax year and you're thinking about taking early retirement, it may not be a good idea to withdraw the taxable element of your pension now, because you may already be a 40 or a 45% taxpayer. You might want to wait until the start of the new tax year to do that, when you're back to being a 20% taxpayer. Moving on from pensions to investments, there are a wide range of tax-efficient investment options. We can only advise on the tax implications of investments. To chat about the actual investments themselves, you would need to speak to a chartered financial advisor. So there are lots of them you consider. ISAs in particular, have you used this year's ISA allowance? Growth and savings that result in interest and dividends within an ISA are tax-free. There's also the Help to Buy ISA, which has closed now, but if you've got money in helped by ISA, you can still continue to put money in there. Lifetime ISAs, stocks and shares, children's ISAs, I think the limit on those is £9,000 a year. They are worth considering, but since the introduction of the personal savings allowance, unless you've got a substantial amount in an ISA, perhaps in a stocks and shares one or a cash one where you're expecting to receive interest or dividends above the personal savings allowance or the dividend allowance, you may not normally consider them, but they're worth a look. Share schemes that we touched on when we were talking about employment, EIS and SEIS. So these are when you would invest in a business. They are generally startups and they are very tax advantaged. So an SEIS company, which is the Seed Enterprise Investment Scheme, would really be a startup. And I believe the tax rate on those at the moment is a 50% tax relief. So if you were to invest £1,000 in an SEIS company, it would reduce your tax bill by £500 for the year. So if you'd perhaps already paid tax on a salary, you might be able to claim some of that back. And an EIS company, it's a startup that's maybe a little bit further down the line, and the tax relief, that would be a 30% tax relief. These are tax reliefs rather than automatic tax refunds, so you do need to have paid the tax in the first place to get it back. But perhaps if there's a company that you're interested in, or you can see it going and doing great things, or it's a family friend perhaps who's set up a company that you want to support, there can be good tax reliefs available for getting involved with those. Similar for venture capital trust investments, community investments, social enterprise investments. And then you can look at things like life assurance bonds and offshore bonds, which is where the bond would grow, but every year you can withdraw up to 5% of the capital that was invested, and that would be tax-free. Just really touched on those. They are a bit more complex than the general tax planning points, but if you would like to discuss them in more detail, you can get in touch with me after the webinar. Be happy to answer any questions you've got on those. So we've covered some of the big tax planning points. We'll move on next to making tax digital, because I think that's going to affect all of us in one way or another. So if you've not heard of it before, making tax digital is HMRC's plan to digitise the tax system. Basically, businesses, organisations and even individuals are going to be required to use software that is HMRC compliant to report their figures, whether that's for the business or from them in a personal capacity, on a quarterly basis, electronically. And the reason behind all of this is we do want to become one of the most technologically advanced tax systems in the world, but it will also, HMRC hope, stop errors from occurring, because what will happen is between you originally keying your data somewhere, whether that's onto a piece of software or perhaps an Excel spreadsheet, there'll be no manual intervention anymore between the original data being input and the figures being submitted to HMRC. Whereas in the past, for example, you might write your figures down on a piece of paper, your accountant or you may type that up onto a spreadsheet or some bookkeeping software. A report would be run on that software to give you some total figures. And then the total figures maybe are either manually typed onto another submission form on HMRC, or they're handwritten onto a return to be posted to HMRC. And it will remove all of those steps where there could be scope for the figures to either be changed by accident or for something to be missed. So it is good. It's just going to be, I suppose, a change that we all need to get used to. So making tax digital is already in place for VAT. It's been in place for VAT for businesses that are compulsory registered for that, which means their turnover is above the £85,000 registration limit. And that's been in place since April 2019. I think that a lot of us thought this was going to be a really big change, and it would be difficult for us to move with the times, I suppose, but it's actually not been that bad. Many people did underestimate the preparations that were necessary, especially if bookkeeping wasn't already in electronic format. But once people have either moved to a package or found support from their advisor or their accountant, it's not been too bad. There was an initial soft landing period, which gave people time to move to the new system, which ended in 2020. So that's no longer around. But HMRC are still looking into how they may issue penalties in future for non-compliance. So they do still understand that people are trying to get their head around Making Tax Digital. The next change for Making Tax Digital will be in April of this year, 2022. From this date, the current regime is extended to all VAT registered organisations. So that includes people who are voluntarily registered because their sales are below the £85,000 registration threshold. These businesses will now need to follow the same rules that organisations currently within Making Tax Digital follow, including using compliance software to report and record VAT information quarterly. That's not to say that everybody needs to move their bookkeeping onto an electronic system, such as one of the online cloud packages or a desktop package. Many people do still use Excel. It's just that now, instead of manually typing those Excel figures onto HMRC's records, you would have to have what's called bridging software, which effectively takes the figures from your original spreadsheet and automatically files them on HMRC's systems. So what do businesses need to do to prepare for the new expansion in April 2020? Need to implement systems that can report and record information each quarter within HMRC's rules. So whatever system you use, you need to be able to keep your records in a digital form. So handwriting a cash book isn't going to work anymore. Those records need to be preserved in the digital form. You either need to be able to create a VAT return from those digital records, which most of the online software providers have the functionality to do, or, as I said, obtain bridging software, which will provide the information digitally to HMRC. And in the background, those systems would also receive information from HMRC. So if you were to use something like an online bookkeeping package, the package would now be able to tell you when HMRC are expecting your next VAT return, what period it covers, and whether it's overdue, and things like that. And you've got to continue to submit that information each quarter. And then when it moves on to things like income tax, you will also need to produce an annual return. So I've just mentioned income tax. Making Tax Digital is going to roll out amongst the other taxes. It is only VAT at the moment, but there is a roadmap. We're probably a little further along now than we were when the map was generated. So we are coming up to April 2020 when all voluntary registered VAT businesses need to use Making Tax Digital. The next tax that this is going to apply to is income tax. That date was originally scheduled for April 2023, but it's been pushed back by a year. So from April 2024, Making Tax Digital for income tax will become mandatory for self-employed businesses and landlords with an annual income of above £10,000. So that's income, the actual amount received from customers or tenants before any expenses have been deducted. So for many people, they may not have a profit of above £10,000, but they will have a reportable income of above the £10,000 limit. A lot of the software providers are currently trying to build software to meet HMRC's Making Tax Digital requirements for income tax. Because the date's been pushed back, not many of these softwares are finished yet. So my best advice right now would be to look at how you can make your record keeping digital. So perhaps for a landlord with one property, you may decide just to use an Excel spreadsheet because you may only have one rent payment coming in a month and minimal expenses such as repairs or insurance. If you're a self-employed business, you may want to consider either using a spreadsheet or moving on to one of the smaller online or desktop packages. I think the biggest change, particularly for these two types of people, small businesses and landlords, is that many of you are used to just providing your information to the accountant at the end of the year. Perhaps you don't complete any bookkeeping and you would just provide your accountant with either bank statements or handwritten sales invoices and supplier receipts at the end of the year. But this is going to be quarterly. So it is something that you could perhaps try to move on to an online system now to give you enough time to get over any teething problems before you're required to do this in April 2024. And then the next tax that Making Tax Digital will be rolled out to will be corporation tax. It's currently scheduled at the earliest to be 2026. However, personally, I am expecting that possibly to be postponed by a year to give them time to get everyone settled with income tax. Again, corporation tax will likely be quarterly. It will need to be submitted electronically. Most businesses that are incorporated companies generally are working on some sort of software or Excel spreadsheets. Many of them will already be VAT registered, so perhaps it's not as big of an issue for corporation tax. So just make sure that you're meeting the income tax requirements before April 2024 if you can. So we've come to the end of the slides now. As I said at the start, we are here to help our clients, whether it's from a general accountancy perspective or an advisory perspective. Maybe you need help tax planning. Nobody wants to pay too much tax or be penalised for falling foul of the tax rules. And my personal motto is always to try and help people pay the lowest amount of tax legally possible. We want to help you keep your affairs in order and minimise your tax bill. So if you do need help or if you've got any questions, do feel free to get in touch. If you've got any questions that you'd just like to be answered now on the webinar, please pop them in the chat box or the Q&A. Or if you'd like to drop me an email and we can arrange a time for a call, or email me any specific questions you've got if you don't want to ask them on the webinar. My contact details are on the screen if you want to take those down. Otherwise, Joe, if we've got any questions off the back of the webinar?
We have a couple, Simone. Let me just run these past you. The first one relates to your comment earlier on in the slides on capital allowances. So what qualifies for the super deduction?
Okay, so there are actually two parts to the super deduction. The big headline rate is the 130% capital allowances. This actually only applies to main rate plant and machinery. So that's things that you would normally claim the annual investment allowance on, so things like vans, computer equipment, bits and pieces like that. And then there is another part to it, which is 50% first year allowances, but that relates to specific items that would normally qualify for special rate allowances.
Thank you. We've got time for one more, actually. We are overrunning a little bit, but we'll squeeze this one in. This relates to cryptocurrencies. So I'm assuming this is things like Bitcoin, for example. Are they covered by the CGT exemption, gains made on cryptocurrency?
Yeah, so they are. In most cases, cryptocurrency will be classed as a capital asset. There are times when it's classed as a trading asset, which could be if if you're trading in it every day and you're making quite significant returns on it, that might be taxed to income. But otherwise, you would be able to claim the £12,300 capital gains exemption against it. And it is important to declare it because a lot of the crypto wallets now are being required by HMRC to report any information they have. So if you don't report it, there is the chance that HMRC could write to you to ask if you've got crypto gains to declare.
That's great. Thank you very much. Well, we are at the end of the webinar time slot now. Thank you very much, Simone, for a really informative and useful presentation. For everybody watching, as I said, we'll have an on-demand version available on the website tomorrow, and we look forward to our next one. Thank you.
Thanks, everyone.